You've got £250,000 saved. You're thinking about buy to let. Your mate swears he's making a killing. Your cousin says it's a disaster. So what's the truth? Is buy to let still profitable in 2026? Or has the game changed so much that you're better off putting your money elsewhere? Let's cut through the hype, ignore the property guru's selling courses, and look at the actual numbers. Real yields, real costs, real profits. Because here's what nobody tells you. Buy to let can still be massively profitable in 2026, but only if you know where to look and what to avoid. The national picture, what the average numbers actually say. Let's start with the UK-wide averages. According to the latest data from Zoopla, Tembo Money, and major property investment firms. Average UK gross rental yield, 5.87% average net rental yield after costs, 4 to 6% average UK rent, £1,320 per month, £15,840 per year. Average UK house price, £268,400. Now here's what that actually means in real money. If you buy an average UK property for £268,400 and rent it for £1,320 per month, you're earning £15,840 annually. That's a gross yield of 5.9%. Sounds decent, right? But gross yield means nothing until you subtract your actual costs. Let's break down a realistic scenario. Purchase price, £268,400. Deposit, 25%, £67,100. Mortgage, 75%, £201,300. Monthly rent, £1,320. Annual rental income, £15,840. Annual costs. Mortgage payment, 5% interest, interest only, £10,065. Letting agent fees, 12%, £1,901. Insurance, £400. Maintenance, 1% property value, £2,684. Void periods, 5% of year, £792. Accountant/admin, £300. Total annual costs, £16,142. Net annual profit minus £302. You're losing £302 per year on the average UK buy-to-let property. This is why so many landlords are selling up. The average deal doesn't work anymore. Not with 5% mortgage rates and rising costs. But here's the key. The average hides where the real money is being made. Where buy-to-let is massively profitable. The real numbers. While London landlords are barely scraping 3 to 4% yields, northern cities are delivering 7 to 9%. And in some postcodes, over 10%. Here are the actual best-performing UK cities for 2026, according to multiple property investment sources. Sunderland, 8.96% gross yield. Average property price, £150,000. Average monthly rent, £1,120. Annual rental income, £13,440. East Ayrshire, Scotland, 7.92% gross yield. Average property price, £130,000. Average monthly rent, £858. Annual rental income, £10,296. Hull, 7.8% gross yield. Average property price, £145,000. Average monthly rent, £943. Annual rental income, £11,316. Bradford, 8% plus gross yield. Average property price, £170,000. Average monthly rent, £1,133. Annual rental income, £13,596. Liverpool, 7 to 7.5% gross yield. Average property price, certain postcodes, £160,000. Average monthly rent, £1,000. Annual rental income, £12,000. Let's run the numbers on a real Bradford buy-to-let investment. Purchase price, £170,000. Deposit, 25%, £42,500. Mortgage, 75%, £127,500. Monthly rent, £1,133. Annual rental income, £13,596. Annual costs. Mortgage payment, 5% interest, interest only. £6,375. Letting agent fees were 12%. £1,632. Insurance. £300. Maintenance. 1%. £1,700. Void periods. 5%. £680. Accountant. £300. Total annual costs. £10,987. Net annual profit. £2,609. Cash-on-cash return on your £42,500. Deposit 6.1%. Now that's a profitable buy-to-let. You're making £2,600 plus per year in cash flow, plus benefiting from any capital appreciation. HMOs, the highest yield strategy for 2026. If you want even better returns, HMOs, houses in multiple occupation, are dominating the market. According to Pegasus Insights Q4 2025 data, HMO rental yields averaged 7.3% compared to 6.4% for standard buy-to-let. Here's a real Manchester HMO example. Purchase price, £200,000. Renovation costs, £30,000. Total investment, £230,000. 5 bedrooms renting at £500 each. Monthly rental income, £2,500. Annual rental income, £30,000. Annual costs. Mortgage, £172,500 at 5%. £8,625. Letting agent HMO specialist, 15%. £4,500 insurance, HMO specific, £800. Maintenance, hire for HMOs, 2%. £4,600. Licensing fees, £1,000. Utilities, often included, £1,800. Void periods, £1,500. Total costs, £22,825. Net profit, £7,175. Cash-on-cash return on £57,500. Deposit, 12.5%. That's double the returns of a standard buy-to-let. But HMOs require more management, stricter licensing, and higher upfront costs. What's changed in 2026? The market rebalancing. The buy-to-let market is fundamentally different than it was 2 years ago. Here's what's shifted. Rental demand down 20% year-on-year. According to Zoopla's December 2025 report, rental demand is at its lowest in 6 years. Net migration dropped 78% from 924,000 June 2023 to 204,000 June 2025. Rental supply up 15% nationally. More properties are available as first-time buyers free up rentals and unsold homes hit the rental market. Rental growth slowing dramatically. Rents rose just 2.2% in 2025, down from 8 to 10% in 2022 to 2024. Zoopla forecasts 2.5% growth for 2026. Mortgage rates stabilizing. Predictions suggest 3 to 3.5% rates by late 2026, down from 5% plus in 2024 to 2025. Profitability declining. 85% of landlords reported profitable lettings in Q4 2025, down from 89% in Q3. The share reporting losses rose by 2%. Translation, the boom years are over, but profitable buy-to-let is absolutely still possible. You just can't buy any property anywhere and expect it to work. The tax reality, what you actually keep. Let's talk about what nobody wants to discuss. Tax, mortgage interest relief. You can only deduct 22% of your mortgage interest costs as a tax credit, not the full amount. Income tax. Rental profits are taxed at your marginal rate, 20%, 40%, or 45%. Capital gains tax. When you sell, you'll pay 18%, basic rate, or 24%, higher rate on profits above your £3,000 annual allowance. Here's how tax affects that Bradford example. Net rental profit before tax, £2,609. Mortgage interest paid, £6,375 tax relief, 22% of £6,375. £1,403. Taxable rental profit, £2,609, plus £6,375 minus £1,403 equals £7,581. Income tax at 40%, higher rate taxpayer, £3,032. Actual cash profit after tax, £2,609 minus £3,032 plus £1,403 equals £980. Your £2,609 profit just became £980 after tax. That's a 2.3% cash-on-cash return. Still positive, but nowhere near as attractive. This is why many investors are switching to limited company structures, where corporation tax, 19 to 25%, may be more favorable. The bottom line, is it worth it in 2026? Buy-to-let is still profitable in 2026, but only if you buy in high-yield areas. Northern cities, Scotland, specific postcodes in Manchester, Liverpool, Nottingham. Avoid London unless you have huge capital. You run the real numbers. Don't trust gross yields. Calculate net yields including all costs, tax, and realistic void periods. You can handle 3 to 3.5% mortgage rates. If rates drop as predicted, profitability improves dramatically. At 3.5%, that Bradford property makes £3,800 plus after mortgage costs. You're in it for 5+ years. Short-term flipping is dead. The profit comes from long-term rental income plus gradual capital appreciation, 3 to 5% annually forecast. You're willing to manage actively or pay for good management. Passive, set it and forget it, landlords are getting squeezed. The era of buying any property and printing money is over. But for investors who do their research, choose the right locations, run accurate numbers, and structure their finances properly, buy-to-let can still deliver 6 to 12% annual returns. Just don't believe the property gurus selling £3,000 courses. The real opportunities are in the boring northern cities with unglamorous postcodes and solid rental demand. Are you investing in buy-to-let or considering it? What yields are you seeing in your area? Share your experiences in the comments. If this breakdown helped you see the real numbers behind UK buy-to-let in 2026, hit that like button and subscribe for more honest property investment analysis with no BS, just data. We break down what actually works and what doesn't. Thanks for watching. Invest smart.